Problem 15. Professor P. Sain wrote a book of accountancy. He gave standard publishers the right to publish the book. The stipulated terms with effect from 1st January 1995 were as follows. So here we have a publisher and an author. The standard publishers becomes the lessee and Professor P. Sain becomes the landlord or the lessor. Royalties at 10% on published price of the copy sold. So we need to see what this is. Royalties at 10% on published price of the copies sold. Minimum payment rupees 6,000 in the first year and rupees 10,000 per annum thereafter. So in the first year it's 6 and then from the second year onwards it's 10,000. The right to deduct in following 2 years any excess of minimum payment over the calculated royalties in any year. So it's in the next 2 years, subsequent 2 years, short workings can be recouped. Revision of books by the author on request and to pay rupees 600 per month to standard publishers for every month of delay after 6 months of requests made by standard publishers. Now, what are they saying here is now what happens when it comes to books? Okay, even though a book is written at one point of time and again after a certain period of time, the book needs to be updated. Okay, so certain changes may be made in the book, certain additions may be made to the books. So as and when the publisher requests the author to update the book or to make changes, the author has to do it. Now what is the agreement here is? The agreement here is the publisher or the lessee gives the author a period of 6 months to make the changes. Okay, if by the end of the 6 month the changes are not made, the author has to pay the publisher 600 rupees for every month of delay. Okay, so the author has to pay the publisher 600 rupees for every month of delay. So the publisher gives the author 6 months. Within 6 months, he needs to make the changes. In case he doesn't do it within 6 months, the author needs to pay the publisher 600 for every month of delay. So remember this agreement. In the event of delay, the condition of minimum amount payable to Professor Sain was not to apply. So in case whenever there is a delay, that minimum rent that has to be paid, okay, in the year whenever there is a delay, the minimum rent that has to be paid will not be applicable. Was not to apply with is will not be applicable. At the end of the third year, Professor Sain was requested to revise the book at the end of the third year. Okay, so at the end of the third year, the revised manuscripts reached standard publishers on 1st November of the fourth year. So basically on 31st December of a particular year, we will see which year it is. On 31st December, the Professor P. Sain was requested to update the book or to revise the book. But the revised manuscripts reached standard publishers only on 1st November of the fourth year. Okay, so we just keep this in mind. Show the necessary accounts in the books of standard publishers. So let's just put in the basic information. Now I've added two more columns here. We have the year, okay. We have sales. We also have sales value. Now why I've calculated sales value is, if you see here, they've given us the number of copies sold and they've also given us the price per copy. Okay, and what they are telling us, royalties are to be calculated at 10% on published price of the copy sold. So how do we do this is, I'm just going to write this here. They said year 1, 2, 3, 4, 5, but I will take it as 1995 because it will become easier. Okay, so on 1st January 1995, I'll take it as 1995, 1996, 1997, 1998 and 1999. 5 years. There are 5 years here. How many are the units sold? The units sold are 1,500 in the first year, 4,900 in the second year. Then we have 5,000 in the third year, 4,000 in the fourth year, and 5,000 in the fifth year. Now, royalty is not directly calculated on sales, on the number of units sold, but on the published price of the copies sold. Now, how are we going to get the total price? Okay, we are going to multiply 20 into 1,500. They have not said on the number of copies sold, but on the published price. Okay, and royalties at 10% on published price. So how to calculate that? We need the sales value. Now how are we going to get the sales value? In the first case, it's 20 into 1,500, which is going to give me 30,000. In the second case, it's 20 into 4,900, which is going to give me 98,000. In the third case, it's 5,000 into 25, which is going to be 1,25,000. In the fourth case, 1,25,000. It's 4,000 into 25, which is 1 lakh. And in the fifth case, it is 5,000 into 25 again, which is 1,25,000. Now, when I'm calculating the royalties, what have they said? It's royalty at 10% on published price of the copies sold. So it's going to be 10% of these values. Okay, because actually if you take 10% of this, you'll just get 10% of this will be 10%, 150. Here it will be 490. That's too less. So it's 10% of the published price. That is the number of copies sold into the price per unit. You get the total and 10% of that. So 10% of 30,000 will be 3,000. Here it's 9,800. Here it is 12,500. Here it is 10,000 and here it is 12,500. Okay. Now minimum rent that they've said the first year it is 6,000. Okay. Second year they've said second year onwards it's 10,000. Now we need to be slightly careful here. They said in the event of delay, the condition of minimum amount payable to Professor Sain was not to apply. At the end of the third year, okay, now here, at the end of the third year, Professor Sain was requested to revise the book. The revised manuscripts reached standard publishers on 1st November of the fourth year only. Now, what is the condition? They said in the case of revision, the lessor or the landlord or here the writer gets 6 months to revise the books. If he does not do it within 6 months, there's not going to be minimum rent in that year, and also he has to pay 600 for every month of delay. To pay rupees 600 per month for every month of delay after 6 months. So basically, if he was requested at the end of the third year, 1997, he gave the manuscripts only on 1st November 1998. Technically, you should have given the manuscripts when 6 months later. So 6 months later, from 31st December 1997 would be January 98, February, March, April, May, June. On 30th June 1998, he should have handed over the revised manuscripts. But he didn't hand it over on 30th June 1998. He handed it only on 1st November 1998 of the fourth year. Fourth year is 1998. So basically, from 30th June to 1st November, how many months delay there was? July, August, September, October. 4 months of delay. So he has to pay 600 for each of those 4 months. Plus, he does not get the minimum rent. So I'm going to put it as not applicable. Why? Because it said here, at the in the event of delay, the condition of minimum amount payable to Professor Sain was not to apply. So this year there won't be any minimum rent. So in the last year, the minimum rent is again 10,000. So I hope this is clear. Okay, why it's not applicable? Because they've clearly said here. So now let's start calculating the short workings. Short workings in the first year are 3,000. The condition for recoupment is next 2 years, so we can't recoup anything. We carry forward the whole thing. Nothing needs to be transferred. Now I put another column for damages for those years where those damages are. Okay, so for those years where those damages are, I put another column for damages. So here in the other years, nothing will come under damages. So payment to landlord is 6,000. Coming to the next year, total short working 9,800 minus 10,000 will be 200. We can't recoup anything. So carry forward, we can carry forward the entire thing. So I'm going to carry forward 3,000 plus 200, 3,200. Nothing to be transferred to P&L account. No damages. Payment to landlord will be 10,000. Coming to the third year now, we have a surplus of 2,500. So if I have a surplus, I'm going to recoup 2,500. Now basically of the first year, this is my last year to recoup, and the first year short working is 3,000. Out of 3,000, I could recoup only 3,500. So I can carry forward only the short working of the next year, and the 500 of the first year I'm going to transfer to P&L account. How did I get this 500? 3,000 is actual short working, but out of 3,000 I can recoup only 2,500. So 500 I can't recoup further, so I transfer it to P&L account. 200 I still have the next year to So this damages, no damages. So how much you'll actually pay is only 10,000 because out of 12,500 you will use 2,500 for each. Now coming to this here, now we need to be a little careful. If there's no minimum rent, there is no question of short working or surplus. Okay, there is no question of short working or surplus because there is no minimum rent. There's nothing to compare it with. We can't say short surplus is 10,000. We can't say that. Okay, we can't say that. There is no minimum rent. Minimum rent is not applicable. So what we are going to do is we can't recoup anything. We have 200 that is still carried forward. So if we can't recoup anything, what we have to do with this 200 is transfer it to P&L account. Why I'm transferring it? Because for this 200, this is the last year. Okay, for this 200, this is the last year. I can't carry it forward. I need to transfer it to P&L. So please don't take surplus as 10,000 here. Now coming to the damages. Now we calculated that the damages is for 4 months. We calculated that the damages are for 4 months and it's 600 per month. Damages are for 4 months and it is 600 per month. So if it's 600 per month, it's going to basically be 2,400 is going to be our damages. Okay. Now how did I calculate that? Revision of books by the author and request and to pay rupees 600 per month for every month of delay after 6 months. So he should have actually submitted on 30th June 1998, but he submits only on 1st November. So there is a 4-month delay. And what is said here is now there is a request. Now what are we going to do with this damages? Basically, the royalty that would have been payable was 10,000, but we are not going to pay 10,000. I'm going to pay 10,000 minus. I'm going to pay 10,000 minus 2,400. That is going to give me 7,600. So this is how this is to be done. Why a minus? Because this is like a penalty for the author because he didn't meet the request on time. So hence these damages are minus from the actual royalty. Okay. And then coming to the last year, now here again we have a surplus. We have a surplus. So even we have a surplus, we cannot use it for anything. So we directly pay the author 12,000. So let's start doing the entries in the books of the who show the necessary in the accounts in the books of the standard publishers. So in the books of the lessee, we have been asked standard publishers, royalties account, short working account, and Professor Sane account. I'll just call it Sane account. Okay, so the first year we have a situation where the minimum rent is more than the actual royalty. So it's royalties account debit, short working account debit to landlord. So here we have on 31st December 1995. By 31st December 1995, it was stipulated terms with effect from 1st January 1995. So royalties are normally paid at the end. So by royalties and by short working. So in the first year, the royalties are 3,000. Short working is also 3,000. So when I'm showing it here, it's going to be 31st December 1995 to Sane. To Sane. We are going to have it as 3,000. And here in the short working also, it will be to Sane. 3,000. Both the royalty and the short working is 3,000. Then we go to the payment. So payment made is 6,000. Check payment made is 6,000. So 31st December 1995 to bank 6,000. And finally transfer the royalties to the trading. Here will be profit and loss account because we are calculating on sales. So 31st December 1995 by P and L account 3,000. Okay, close the books. 6,000, 6,000. Close this. You will have a balance carried down here. 31st December, by balance carried down 3,000. Bring down the balance. 1st January 1996 to balance brought down 3,000, and this automatically closes. So we now move to the second year. Again, we have a similar situation where the minimum rent is more than the actual royalty. So the same entries again. Buy royalties and buy royalties and buy short working in the landlord's account. So in the second year, the royalties are 9,800. Short working is 200. 9,800 and the short working is. So accordingly, post this in the relevant accounts. 31st December 96, 9,800. 31st December 96, short working to same. Then we go to the payment, landlord account to bank. 31st December 96. If you see how much is being paid, it is 10,000. Payment is 10,000. Finally, transfer the royalties to the P&L account. 31st December 96 by P&L account, total of 9,800. Yeah, we have to close this now. The others, this close the accounts. 10,000, 10,000. Close this. You will have a buy balance carried down. 31st December 1996, buy balance carried down will be 3,200. Okay, if you check here, balance carried forward is 3,200. Coming to the third year now, we have a situation where the royalty is more than the minimum rent. So it's royalties account debit to sane account. So in sane account, it will be buy royalties. 97, buy royalties. I think it is royalties are 12,500. So if you say buy royalties here in royalties account, it will be to sane. 31st December 97 to sane 12,500. Then we have the payment, landlord account to bank, and in case there's any short working recoup, which is recoup. Plus we also have a short working to P&L account. So lots happening here. So in the landlord account, we have to bank, to bank. How much is being paid to the landlord? 10,000. 10,000 is being paid. And also there's a short working recoup to short working recouped, which is, I think the short working recouped is 2,500. Short working recouped is 2,500. Okay, so if we say to short working here, in short working account, it will be by sane. Forgot to bring down the balance here, just bring down 1st January 1997 to balance brought down 3,200. Here we have it as on 31st December 1997 by sale, that is 2,500, which is recouped. Okay, and also we also have something going to the profit and loss account. We have 500 transferred to profit and loss account. So it's P&L account debit to short working. So in short working, it is by P&L account. And how much is being transferred? 500. 500 is being transferred. Okay. And then we transfer the royalties to the P&L account. By P&L account, 12,000. Close this. Here you will have it's tallying here. 12,500. 12,500. Then we have short working. I think there is a balance carried down. So the total here is 3,200. 3,200. And by balance carried down is 3,200 minus 3,000. By balance carried down is 200. So if you check the statement, you will have a balance carried forward of 200 here in the third year. Balance carried forward of 200 in the third year. So bring down the balance immediately. 1st January 1998. 1st January 1998. To balance brought down is 200. Okay, this automatically tallies. Going to the fourth year now. In the fourth year, we have a situation where there is no minimum rent. There's only actual royalty. Okay, so we need to see what the entries are as usual. The entries are as usual where the royalty is more than the minimum rent. So the first entry will be royalty account debit to short working account. Sorry, to landlord account. So in landlord account, we'll have buy royalties. In 1998, buy royalties, and the royalties in that year are 10,000. Yeah. Royalties in that year are 10,000. Okay. Then we have the payment. Now we need to be a little careful with regard to the payment. So it's normally landlord account to bank. Okay, landlord account to bank, and we need to show something. Now when we are paying the landlord, we paid only 7,600. Actually the royalty was 10,000, but we paid only 7,600. Where the balance went? The balance went towards damages. Okay, so when we are showing the pay entry, we have to say, put it as landlord account to bank 7,600, and to damages, we call it to damages, and that is 2,000. That's what has happened. 2,400. Out of 10,000, 7,600 was paid, but 2,400 was not paid because those were it was recovered towards damages. So this is the only entry. Okay, so this is the only difference. There's nothing else happening with regard to recoupment of short working carry forward. But there's something happening with regard to transfer of short working to PNL account. Okay, so what will be the entry? PNL account debit to short working. So in short working account, we will have this transfer by on 31st December 1998 by P and L account. That is okay. And finally transfer. Oh, I didn't post this here. Same entry. Finally transfer this to the PNL account. I think this is 10,000 here. This happens as usual. I had missed posting this. Okay, take that into account. I miss posting this, but the end of the year it transfers to the P&L account. So if you see this one tallies, the total comes to 10,000 here. 10,000, 10,000. Then we have here the short working account also tallies. This also tallies. Okay, so I don't think we have any short working, so I'll delete this. And this one also tallies. But we still have another year to post. In the last year, it's a very simple thing. Royalty is more than the minimum rent, so the same entry again. On 31st December 99, by royalties, you will have it as, I think the last year's royalties are 12,500. Royalties are 12,500. Okay, so if you say buy royalties here, you'll have it as 2 sane. 12,500. Next, we come to the payment. Landlord account to bank. There's nothing happening. No short working recoup. Nothing happening. There's nothing happening. No P&L account. So we won't have anything to do with short working. So landlord account to bank. Just that much. You're paying the landlord everything to bank on 31st December 99. 12,005. You check. You'll be paying the landlord 12,000. And finally transfer this to the P&L. 99, 12,000. So just close this. Close this. That's how this problem is. So the only difference is because of this damages and the minimum rent not being applicable. So that don't assume that there is a surplus here. Okay, so there is no surplus, neither short working. We don't consider minimum rent, hence we don't consider short working or surplus.